is Jeremy Friesen. He's commodity strategist at Societe Generale. Okay, we've got a lot of things playing out. I mean, what way do concerns about the European debt situation really hit the oil price?
Oh, I definitely think that's one of the key risks going through 2012. We think that fundamentals are actually continuing to erode. But
that means less demand, doesn't it?
It does, and I think that if you didn't have some risk issues like Iran, that prices would start falling. We still think that given these two-sided risks, that oil is going to kind of range around the 110. But you could see prices spike up if there is increased tensions or, God forbid, some sort of supply disruption related to military.
Yeah, but I mean, there has been a lot of saber rattling, and we hadn't been, talking about that for a while, because remember they used to have those Silk Oil missiles that used to fire randomly, sometimes the Iranians, which used to spook traders, and oil would go up. But I mean, how realistic is it that we could see a blockade of the Straits of Hormuz? And given, of course, in Bahrain, we've got the U.S. Fifth Fleet waiting there. Well,
it's absolutely really easy for them to do that. The commander was saying it would be like drinking a glass of water. Well, I think maybe the analogy is more like drinking a glass of antifreeze, because it's something easy to do, but certainly not in the best health for Iran. So you can see the price action. There has been some increase over the last few weeks. Part of that is given the good economic data we've had in the U.S. But I think that you can really take out of that the market is discounting to a certain degree either the willingness of Iran to do that, given that it hurts them as much as anyone else, or maybe the ability, because as you said, the Fifth Fleet there are a lot of military assets, and they would, by doing it, they wouldn't be making any friends. So it's certainly not in their best interest.
What do we also take from the timing here of President Mahmoud Ahmadinejad's visit to his, dwindling band of friends in Latin America now?
Right. Obviously he's trying to shore up some support. There's going to be some really interesting politicking that he's going to have to do. They want the price to rise. They want to have the markets very unstable, because they would rather have the EU kind of pull back from their willingness to put in sanctions. They want to convince other partners to not cooperate with the U.S. And they want, frankly, convince the U.S. To back off and really not go through with the sanctions that are expected to begin at the end of June, but really have a lot of discretion. And I think because it has discretion, they can use the market price of oil to kind of moderate the sanctions, and that's in the best interest of Iran.
Well, ironically, if they have sanctions imposed by the EU and various other people, who get into bed with the United States and refuse to buy Iranian oil, they'll shove the price up, but they may be forced to sell their oil at a discount, and that's the irony.
Absolutely. So the more that they can dislocate some of the exports from Iran, Iran's got to have this oil that it would sell to the EU or EU members, and it has to sell to other countries like China. Well, China will take it, but there's a price that they'll take this oil. So certainly that doesn't help the finances of Iran, which takes a lot of its money from the oil industry.
Yeah. What's the base case scenario at the moment? All things catering paribus, all things remaining the same.
Yeah. Well,
over the course of this year?
If all things were equal, which they're not, we think that strict sanctions from the EU, which would eliminate all the imports from Iran to the EU, that would probably bring prices to 125 to even 150 if you had other OECD countries like Japan or Korea helping or being more hawkish in that vein. But things aren't equal, as you said, and as I said, there will be some to and fro, because if prices go up, it'll reduce the willingness of even the U.S. to really implement fully the sanctions, because there's a lot of discretion that's built into the law, and they can give waivers, and so it gives, in this important election year for the U.S., it gives them some out and not be kind of stuck with a really high oil price.
Well, the irony is as well here, sorry to keep using that word, is with the U.S. the way it is too right now, with it producing more and more oil compared to before as well. So, the reliance on foreign crude is perhaps not quite as marked as it used to be.
It's definitely a lot, and China actually is really reliant on Middle Eastern crude. But still, it's a global market, so any disruption, even if it's sour oil or light sweet with Libya, it affects the whole market, and it would affect U.S. growth. So if we did see oil prices rally to over 125, 150, that could be a very big challenge for the U.S. growth, despite the fact that there seems to be some good momentum there.
And Europe should take a huge economic hit from this as well, wouldn't it? Just at a time when they're trying to get back onto their feet.
Absolutely. And interestingly, because of the weaker euro, the eurozone is really paying the kind of prices they would pay back at the peak there in 2008. So it's really a strong de-stimulant for them. And a lot of the countries that are importing are the weaker countries. Italy, Greece, Spain. So there's a lot of interesting politics that are going to go on in Europe as well.
Well, thank you very much indeed for that, Jeremy. Just